Gentlemen, please take your seats. The committee is still in session. We appreciate all of you for being here and apologize for the congressional schedule deferring your appearance. Appreciate you staying here. And we'll begin our testimony of the third panel, with Mr. Andrews.
Mr. Minnick, thank you very much for the opportunity to come here today. I'm Steve Andrews, President and CEO of Bank of Alameda. It's a bank in San Francisco Bay Area, Oakland. I'm a state chartered bank operating in the state of California, roughly 250 million assets. I'm pleased to be here today to address the panels as well as the committees with respect to state of small business and real estate lending in local markets. I'm also very pleased to represent 5,000 community bank members for the Independent Community Bankers of America. Bank of Alameda is like most small banks. We specialize in small business lending, we specialize in real estate lending, we specialize in relationship lending. Community banks across the nation, some 8,000 community banks, staying ready and prepared to continue to lend into their communities and support those businesses that require stimulus and recovery. My bank faces serious challenges. We just heard from a series of regulators up here about their work trying to mitigate some of those challenges. But the facts remain that community banks are operating in the toughest economic climate and the most severe regulatory climate we've seen in over 2 decades. We've heard about the pendulum, and from community banks' perspective, that pendulum has moved too far into the category of overregulation at the expense of lending. And we see the results of that with many of your constituents coming into your offices and worrying about the allocation of credit. The regulators are questioning real estate values. They are making subjective calls on the street and in community banks, and that is creating an atmosphere where many banks are reticent to make viable commercial small business loans. While the economy has suffered, and certainly some of those CRE borrowers you see out there are having trouble financing and making their payments, regulatory burden has added another category and stress to the situation. We also have fairly healthy economies that exist in the United States. Even in those areas, community banks are suffering because regulatory constraints are asking them to reduce overexposure in the CRE area. The regulatory environment is tough. Some of our best clients in the Bay Area come into us and cite it's not only that, it's that we are concerned to invest today. So yes, there is an element of our borrowers that are concerned to invest and take out additional credit because they're not sure, as all of us here today are, when this recovery will take effect. I want to concentrate the balance of my remarks mostly with the regulatory environment. I do see, and believe me, I represent 130 bankers in California representing the CIB, California Community Bankers, Independent Community Bankers, and the ICBA, that banking regulators are making tough decisions in the field. This guidance is relatively new out in November, but anecdotally I am seeing that the regulators do have their throat and do have their feet on bankers' throat in some cases, as we heard from the first panel. In my Pacific example, regulators came into the bank, they raised our leverage ratio from the 5% statutory minimum to 10%. In that case, what happens is you have to adhere to those agreements, and it inhibits our ability to lend. Our bank has had to reduce its balance sheet. Loans outstanding at the end of 2007 were roughly 248 million. Today, they sit at 200 million. That's not a way to make the economy recover. Although my bank meets the higher 10% thresholds, it does come at a heavy toll. Field examiners, when they come out today, are getting mixed messages. They're hearing from Congress, they're exhorting the banks to lend. I think sometimes they're also hearing that they need to remain tough and make sure that they have a tough regulatory environment so we get through this rough patch. It's not an easy job, and I felt a little sorry at some point for the regulators who were in the room, but the reality is that they're making very tough on community banks to lend, and banks are reticent, especially when we have these high capitals imposed on us, Also, when we're asked to bring our loan loss reserves to exceedingly high thresholds, that impairs our ability to allocate capital into lending. In closing, I'd like to say that the Independent Community of Bankers fully endorses the $30 billion fund we've chatted about. We think that's a very prudent idea. At the same time, we also want to make sure that some of the stigmas attached to the TARP financing is not placed with this. I think Herb Allison, when he spoke correctly that there is reticence upon bankers to jump into a fund like this if there's going to be a lot of hooks into that. Bankers do not want to see the deal change after it's out. Thank you for your time.
Thank you, Mr.